There are many ways to find great companies to invest in, but one of the best shortcuts is to start with the portfolio from a legendary investor. Then pick the best stock from their list using your own methods. For me, that's the discounted future free cash flow analysis. Grab a drink, take a seat, let's talk about it. What's up, y'all? It's Brian. This is my YouTube investing portfolio series where I invest in a different company every single week. And because it's a new company, every week I have to get creative with how I find companies that are investment worthy. And there's lots of ways to find great companies. Maybe they have a great business model. Maybe they have a strong economic moat. Maybe they have a technological advantage or a economy of scale advantage. There's tons of things. Maybe they have really loyal customers. There are so many things that I could look for, but guess who's already done all the hard work? Warren Buffett. He is famous for saying it's better to invest in a great company at a fair price than a fair company at a great price. So Warren Buffett, he's already got a list of strong, solid companies that are durable and profitable. So why not just start there and then find the one that's currently trading at the biggest discount? First, let's go to Warren Buffett's portfolio. On datarama.com, I have pulled up Warren Buffett's portfolio with Berkshire Hathaway. His top investment holding is Apple. Then he's got American Express, Bank of America, Coca-Cola, Chevron. The list goes on. There's tons of companies here. This also shows his recent activity, which I'm not going to be focusing on so much. As long as the company is still in his portfolio, I'm going to assume that it's a great, durable, profitable company. And I'm just going to find which one is the best deal. So what's the best way to do that? I took his whole portfolio and I made a custom stock screener on stockanalysis.com. So here's my watch list with all of Warren Buffett's portfolio. And then I adjusted my own custom screeners within that watch list. So I put the price to free cash flow ratio, the PE ratio, revenue growth over the next 5 years, because future cash flows are going to depend on their future revenue growth. That's important. Their gross margin, operating margin, and profit margin. So these margins are really important to me because companies that have a higher gross margin, operating margin, and profit margin typically have a competitive advantage of some kind. That's something I like to look for. And then as far as valuation goes, PE ratio is important. However, I prefer the price to free cash flow ratio. How much free cash flow am I getting for every dollar that I spend on this company's stock? So looking at that, first thing I'm going to do is I'm going to filter these by price to free cash flow ratio, not at the top. I actually want the price to free cash flow ratio to be low. If the price to free cash flow ratio is very high, then I'm not getting as much free cash flow per dollar spent. So starting at the bottom, if there is no entry right here, it means I think that the free cash flow is negative currently. Doesn't mean they're constantly having negative free cash flow, but I'm not wanting that. I want the lowest possible free cash flow, which is COF. This is Capital One Finance has the lowest. Their PE ratio is relatively low. Let's actually do a quick filter for PE ratio and see where they're at. So they are towards the bottom. They're in the top 10 on PE ratio. Let's filter by price to free cash flow ratio one more time. They have a solid revenue growth over the next 5 years, 13.57%. That's great. It's the best actually of the ones that have a low price to free cash flow ratio. Their gross margin is not showing anything, so I do need to look into that. But their operating margin is great and their profit margin is great. Both of those look really, really strong. So now I'm going to go to their financial statement. Capital One Finance does not have a gross margin metric or a gross profit metric on stockanalysis.com. I think that's because they don't have the typical business model of revenue and then cost of goods sold because they are a financial institution. So what I'm going to do to kind of simulate the gross profit margin is I'm going to look at the total interest income and then look at the total interest expense. So their net interest income is 31 billion. Their total interest income is 46 billion. So what percentage is 31 of 46? That is 67.8% margin. So that looks really strong. So Capital One Finance is meeting all of my requirements as far as Warren Buffett's portfolio, which companies look good. So if I pretend there is a 67.8% gross margin right here in this category, Capital One Finance destroys everybody in its immediate vicinity of the companies that have a low price to free cash flow ratio. Just out of curiosity, if I filter by gross margin, Capital One Finance would be number, what is this? 1, 2, 3, 4, 5. They would be fifth place overall in terms of gross margin, but it just doesn't calculate it that way on stockanalysis.com. So Capital One Finance is going to be the company that I look at to do a free cash flow analysis. This is my automated spreadsheet that I use to make the discounted future free cash flow analysis very fast and convenient. All I have to do is type in the ticker, and then everything in this data formatting section, all of this is pulled automatically from stockanalysis.com, all this information for the ticker that I put in there, which is Capital One Finance. So currently their share price is $73.17. One of the first things that I have to enter whenever I'm doing this manually is the revenue growth. So the analysts are saying that in 2025, they're projecting huge revenue growth, and then it differs quite a bit going forward after that. So I'm going to be generating 3 different projections, at least high, average, and low revenue projections, using that with their free cash flow margin to calculate what I think their future free cash flow is going to be. So free cash flow margin is just the percentage of revenue that they generate free cash flow. Pretty straightforward. That way I can implement the analyst projections into my personal projections. After copying that in, I also need to enter my own projection for revenue growth. I'm going to assume that the next 5 years is 3%, the 5 years after that is 3%, and then perpetual going into infinity is 3%. And I can adjust these a little bit to kind of see what prices come up. But this is just my first stab at it, just using inflation to see what is the stock price going to look like if their revenue just grows with inflation. Also, I have to enter in the discount rate. This is how much I want to discount the future free cash flows. This is affected by the perceived risk of the company. And so to calculate this, I go to alphaspread.com and they use the risk-free rate. So what rate can I get risk-free from bonds, basically? They use the beta for the company, which they're looking at the volatility, how much movement is Capital One experiencing. They use all this to calculate the cost of equity, which is the discount rate that I use. You could up this to 10% if you want to discount their future cash flows by a little bit more to be more conservative. Nothing wrong with that. So with that in mind, with the analyst projections pasted in, with their future free cash flows calculated based on that, the fair share price today is insanely high, $825 per share, if they're able to grow at 3% going forward, which is insane to me. Their current share price, $173. It's crazy how low their current share price is. So what that's telling me is the market is assuming that Capital One Finance is going to be shrinking going forward. And maybe they will. We have a strong chance that we're going to be entering a recession. I just saw the latest GDP estimates for the first quarter of 2025 is showing negative growth in GDP. If we have GDP negative growth for 2 quarters in a row, then we are officially in a recession. So if I change this to 0 growth just to see what share price comes out, I'm still seeing $438 per share on my projection for 0 growth. It's absolutely insane. The next thing that I want to tweak is the past free cash flow margin. So currently they're showing 61% free cash flow margin. If I go to the cash flow tab, okay, down here at the bottom, free cash flow margin. So the last 2 years, they've had really great free cash flow margin. And in 2020, they had insane free cash flow margin. In the interest of being a little bit more conservative, maybe these years are a little bit outlier years, and they're more likely to have 45 to 50% free cash flow margin. If I make that assumption and I reduce their expected free cash flow margin by, say, 20%, that way I'm assuming the next 5 years, they have 41% free cash flow margin. That changes their current share price to $253 per share. This company is just so on sale. It looks like it's too good to be true. Additionally, if I look at this graph down here that shows their shares outstanding, this company is continually spending money on share buybacks, which I also like to see. Not only are they incredibly profitable, they pay a small dividend, they use their money on share buybacks. This company is incredibly undervalued. So this one's a no-brainer for me. I am investing in Capital One Finance this week, $100. That's how much I do every single week. And now let's take a quick peek at my portfolio to see how it's doing. So far, we have $1,500 in the account with $1,400 invested. At the time I'm shooting this video, we are up a shocking $9, which means we have a money weighted rate of return of just 1%. So we're basically flat, and I'm okay with that. If I look at the current or the last 3 months of the S&P 500, it's down quite a bit. It's a tough time to invest. And that is where the rationale for my strategy comes into play. I am trying to find value companies. I want to find companies that are already trading at a decent discount to be a little bit more defensive. I'm not trying to make super high growth plays right now, because if the market is about to go into recession, then growth companies are going to get hit much harder than value companies. I want to find companies that are already a little bit undervalued. That way they don't have as far to fall in the event of a recession or a market crash. So looking into the companies that I have so far, the ones that are up are Crocs, Hims, British American Tobacco, and Capital One, which I just invested in, basically flat. Hims is carrying the portfolio right now. It is up 40%. And then I have several companies that are down solidly, which I need to look into further to see if I still want to hold these companies, if something's changed with their fundamentals, or maybe they're just trading at a bigger discount now than they were before. DocuSign down 14%, Zeta down 11%, and Google down 11%. Those are my worst holdings. Everything else is roughly flat. We got 5%, 0.2%, 7.5%. Overall, I'm happy with the performance of the portfolio. I'm going to continue to make value investing plays. And if you want to see the most recent video in this series, check it out right here. I'll catch you on the flip side. Cheers. Oh, that's a good bourbon. Jefferson's Ocean. Aged at sea.